Hello, everyone, and welcome to the Inside ETFs weekly webinar. My name is Matt Hogan, and I'm the CEO of Inside ETFs and your host for today's webinar. In today's show, a special treat, Richard Bernstein telling you where to invest in 2018. I, for one, can't wait to hear what he has to say. Rich has an uncanny ability to make the complex simple and to see through the noise to identify real opportunities that matter to investors. With valuations stretched across the board, I want to know, where do we look for strong returns in the new year? Or is 2018 more about protecting your portfolio than profiting? In today's show, we'll ask, will the best performing ETFs in 2017 be the place to invest in 2018? What sectors, countries, regions, and themes are best positioned to outperform? Is it time to look at investing outside the U.S. and underweight U.S. stocks? Richard, of course, is the CEO and CIO of Richard Bernstein Advisors, LLC. In his role as CIO, Rich leads RBA's investment committee, which manages all of the firm's investments and performs executive management functions as CEO. Mr. Bernstein founded Richard Bernstein Advisors in 2009, but he has 35 years' experience on Wall Street, most recently as the chief investment strategist at Merrill Lynch & Company. He was voted to Institutional Investor magazine's annual All-American Research Team 18 times and is one of only 57 analysts inducted into the II Hall of Fame. And we have him here today. But that's not all we have today. Before we get to Richard and his views on 2018, we're going to speak with Matthew Bartolini, Vice President and Head of SPDR America's Research at State Street Global Advisors. He's here to play our game, 5 questions in 5 minutes, where we hit him with 5 hard questions about big news in the market. He's going to be talking about core investing, portfolio construction, controlling for costs, and targeting outcomes with the new ultra-low-cost SPDR portfolio ETFs. SSGA has made big news in the ETF industry with the launch of those ETFs, and we're going to chat with Matthew about how investors can make use of those funds to build better portfolios in the year ahead. Matthew, welcome to the show.
Thanks, Matt. Very happy to be here.
All right. I've got the clock next to me. I'm going to push go now. We have exactly 5 minutes. And let's start with the basics. What are SPDR portfolio ETFs?
Well, there are 15 ultra-low-cost core building blocks. They cover domestic and international equities as well as broad fixed income categories, but also areas of the credit curve and treasury curve. They're really there to help you build well-diversified core portfolios that you can then tailor to your client's risk and return expectations as well as time horizon. Among these 15, you can broaden your reach. You can gain transparent and cost-efficient access to all corners of the world. You can manage your risk and return by dialing up or down your small cap or EM or value or growth exposures. Or you can seek income by striking a better break even within the intermediate bond segment of the corporate market, or just allocating to high dividend payers. So there are 15 ultra low cost core building blocks, and I think that's what investors may need today to develop that type of core portfolio.
Okay, I get it. They're great tools. They give you exposure to different slices of the market. But why is core investing an area investors should focus on? Talk to me about the low-cost story that's such a big piece of these funds.
Yeah, so low-cost core investing, a strong, flexible portfolio really depends on how you allocate assets in the core. That's because the cores should generally be the largest part of your portfolio. And research has shown that asset allocation essentially explains 90% of the variance in returns in portfolios. So it really all starts with asset allocation. And in today's low return expectations environment, building a low-cost, diversified core portfolio is more important than ever. And a lot of that has to do with that if your return expectations are lower, the cost that you're outlaying to get them shouldn't be that high. So over time, considering costs accumulate and overriding those returns, you should really seek out ultra-low-cost exposures to really go towards the values that portfolios need to have. Broad, customizable, cost-efficient, and really disciplined. We talk about that a lot around rebalancing. The discipline of rebalancing should be inherently included in any sort of core investing story.
Now, what drove you guys to launch these portfolio ETFs now? You've been in the market for 25 years, so why now?
So a lot of it just comes down to buying behavior. We've noticed a market regime shift over the past years with all types of investors favoring lower cost exposures. Through the first half of 2017, nearly 60% of flows went into those low cost providers. But we've also, beyond that, continued to hear from clients that they wanted another solution for core portfolio building. So with those two sort of buying behavior traits in the marketplace, we sought to lower costs and really provide that pricing leverage for our clients within their business, while all the while allowing them to create portfolios the way they want to. So simply put, we entered the market to provide the freedom for our clients to construct core portfolios in the manner in which they seek, whether that's to generate higher returns, manage risk, or diversify their entire portfolio.
Okay, so that sounds reasonable. How have the funds been performing, and are they trading as you would expect them to?
Yeah, I mean, the funds have been performing great, and we've already amassed close to $1 billion since launch in terms of flows. So the investor reaction from net new asset perspective has been overwhelmingly positive, and trading has been equally as positive, if not more. On-screen liquidity in terms of trading volume has essentially doubled prior to the volume previous to launch. Bid-ask spreads are basically between a penny or 3 cents depending upon the product. And that's really important because when we sought to enter this market, we knew that if we launch new products, the trading volume may not be there. And we've been a firm that has been on the front line in terms of really advocating for total cost of ownership and trading costs. So that's why when we restructured the product, we want to ensure that investors were able to allocate to these ultra low-cost core solutions with existing liquidity and existing AUM to provide them the confidence they needed. So the reaction has been really great, and the trading volume has been equally as great.
Awesome. Well, we have about 45 seconds left. One last question. What drove your decision to self-index a few of the funds?
Yeah, so when looking to lower costs, we want to ensure that we are lowering costs where feasible and where applicable. So when reviewing our product and lineup structure, we chose to go to a self-index route to provide that pricing leverage, but also it was a result of our expansion of self-indexing capabilities. We've had other self-indices in the past, particularly within the ESG and Smart Beta indice, and this is just a natural extension. But overall, I mean, we remain very much committed to FTSE Russell as a partner. I think they're very excellent in all of this, all of our entire project, and we just saw this time to continue our expansion of self-indexing and really try to lower costs aggressively where possible.
Awesome. Well, we applaud you bringing these ultra-low-cost funds to the market, and we thank you for joining us today and getting all your answers in 5 minutes. That was great. Now we're going to bring in Richard Bernstein here to talk about his views on where investors should be placing their bets in 2018. All right, Richard, thanks so much for being here. So let's start with the big picture. Tell me, where exactly should investors invest in 2018?
Well, Matt, I think it's a little bit hard to say right now definitively what 2018 is going to look like, but I think it's a pretty fair guess that profitability will continue to accelerate both in the United States and globally, at least through the first quarter, if not the first half of 2018. So I think starting the year, it's very appropriate to have a cyclical bent to a portfolio. Very traditional sectors, emerging markets, things like that.
But aren't valuations hugely stretched? Everyone I talk to say there's nothing you can buy. Valuations are at their peak. The end is nigh.
I'm not quite sure it's that dire the way people make it out. Look, it's not March of 2009, right? This is not the beginning of a bull market. We're now 8 years into a bull market. So to say that valuations are cheap, I think is kind of stretching it a little bit. However, I don't think we're close. I will repeat that. I do not think we are close to end-of-cycle type valuations. Why do I say that? I say that because, a lot of times people look at valuation, for instance, the one that everybody loves to talk about, the Shiller PE. And they look at the Shiller PE in isolation. And look, I used to teach in the grad school at NYU for many years. And when you teach valuation, you never teach valuation without an interest rate comment. There always has to be an interest rate component to any valuation formula. And people don't realize that a PE ratio is one of those valuation formulas that requires a PE to go with it. So to say that an interest rate to go with it. So to say that, a PE is 8 or 10 or 12 or 16 or 18 is a meaningless concept. It just doesn't mean anything, because you have to say, we have a PE of 8 and an interest rate of X. We have a PE of 10 and an interest rate of X. We have a PE of 20 and an interest rate of X. Then you can make sense of what that PE ratio says. But just say the PE ratio is 10 or 20 is meaningless. It just doesn't mean anything. And so what we've done at Richard Bernstein Advisors, what we've done here at RBA, is all our models look at valuation relative to interest rates. They always have. Even when I was at Merrill Lynch for many years, that's what we used to do, and they do today. So let's take the Shiller PE, and if we adjust it for interest rates, what's the 12-month expected return? Well, it turns out to be about 8 to 10%, given current interest rates. Well, what's the long-term expected return on the S&P 500? Gee, it's about 8 to 10%. So I think all the Shiller PE and those type of measures are telling you is that we're in some kind of a normal return environment, not abnormal, meaning it's not March of '09, you're not looking at 20% type returns, but you're also not looking at a peak cycle where you're looking at minus 20%. You're looking at something very right now in terms of expected returns from valuation.
Then you must not be concerned about a huge rise in interest rates in the year to come either, right? Because that would be the other piece that would rapidly shift that valuation argument.
Well, funny enough, we actually do think that interest rates are likely to rise over the next year, year and a half, potentially more than people think. And you might say, as your question implied, well, how can you tell me valuation is not such a big deal if you think interest rates are going to go up and multiples are going to compress? The reason we don't think it's such a big deal is because when interest rates go up, let's take the 10-year for the point of discussion here. If the 10-year interest rate goes up, there's only one reason why that rate would go up. And the one reason that rate would go up is because nominal growth in the economy, nominal meaning real plus inflation, nominal growth in the economy is stronger than people think. And if nominal growth is stronger than people think, it probably means that earnings are stronger than people think too, because earnings are nominal. So if that's the case, yes, PE ratios contract as interest rates go up. We all know that. But is your multiple compressing in that rising rate environment because the P in the PE is going down, or because the E in the PE is going up? I mentioned before, we are very cyclically positioned. Those are the type of stocks that do well in a rising rate, multiple compression type environment. People forget there's two kinds of bull markets. There's interest rate driven markets when PEs expand, and there's earnings driven markets where PEs actually contract, and the earnings effect is much stronger than the interest rate effect, and that's really what we're looking at, what we think is going to actually happen.
Awesome. One more general question, then I want to dig into some sectors and asset classes. You mentioned that you were excited more for the front half of next year than for the latter half. Why is that? Well,
I think right now, as I said, Matt, the first half of the year has a little more visibility than the second half of the year. And the first half of the year, I think it's a reasonable assumption that profitability will continue to accelerate. As you go through the second half of the year, comparisons for a lot of sectors, a lot of industries, a lot of countries start getting tougher, and it's a little bit more difficult to see what's going on in the second half of the year right now. So I still think that, once you kind of ride the cyclical wave and then assess the data as we go through 2018. I know everybody's supposed to have one view for the whole year. I'm not quite sure this is the time to make that one view for the whole year. Rather, I think you want to try to divide it up into a period where earnings are accelerating and maybe where earnings are topping out.
All right, I love it. I'd remind the audience you can ask a question of Richard using the Q&A toggle on your webinar screen. But I want to ask a question about technology. In our sort of pre-discussion, you mentioned that you guys are significantly overweight technology. I guess there's concern out there that we might be entering a bubble phase in the sort of software eating the world phenomenon. Have we seen, elements of that creeping in? Are you worried about that?
Right, I love that software eating the world, but yeah, maybe software is eating the world, and maybe it's becoming kind of gluttonous. I don't know, but I think, look, we have been overweight tech for the past 7 quarters, I think it is, and it started 1Q16. And the reason why was that we thought profitability in the United States was beginning to trough. It subsequently troughed in 2Q16 globally. And if you look historically at what sectors perform the best when profitability is accelerating, the number one sector is the tech sector. In this cycle, profitability has accelerated, and sure enough, tech has been the number one performing sector. Now, that's great, except there's a dirty little secret underneath that. And if you think about what I just said, tech is the number one performing sector when profits accelerate. What that means is that tech is a deep cyclical sector, and always has been a deep cyclical sector. And we are we have been for the past 7 quarters substantially overweight tech, because we realized it was a deep cyclical sector, and we wanted to try to take advantage of that deep cyclicality. What tends to happen is, as the cycle matures, people begin to confuse that cyclicality in the tech sector for growth. And you begin to hear stories about how they're changing the world. Matt, I think earlier you mentioned in our discussion before about, this time it's different, and all those kind of things. And you're clearly starting to hear that. But I think investors want to be very cautious about extrapolating the trend. Yes, we are still in a cyclical upturn, so the story is still party on. I see nothing wrong with that. We're maintaining our significant overweight in tech because profitability is still accelerating. But one wants to be very, very careful about falling in love with the tech sector, about some new world order. This time it's different, brave new world. Use whatever you want. That's usually the kiss of death for tech. And I think investors will get burned, as they always do in tech, mistaking the extreme cyclicality for growth.
One question follow-up on there. So I presume you don't think the tech sector's in a bubble right now, even with Tesla at $51 billion. What about the private tech sector? Do you worry about a bubble in private securities?
Yeah, no, I just want to correct you. You said something, and I wasn't clear, and thank you for bringing that up. I don't know if it's a bubble. I don't want to necessarily use that word, but valuations in the tech sector are silly. They are silly. I mean, the example you used, I'm not going to name names, but you used an example of a company that has, basically burned through capital like there's no tomorrow. Not quite at a historic rate, but probably pretty close. There's lots of examples of companies with negative free cash flow burning through capital like crazy and just coming back to the market for more and more and more capital. Yeah, I mean, that's very reminiscent of 2000, of course. And I think one wants to be very cautious about investing, willy-nilly in companies that are constantly asking for more capital and then burning through it like there's no tomorrow. That's never been proven to be a good strategy. So, a lot of people think all of a sudden they're venture capitalists. That's not the way a venture capitalist thinks, right? I mean, a venture capitalist has an end game, and it's a very specific end game, and it's planned out long in advance. So one wants to be very careful. However, again, those valuations can stretch further as long as profitability is heating up. And I think that's the key thing is to realize, cyclicals always get extended valuation at the peak of the cycle. And this time it's no different, whether it's tech or whether it's any other cyclical sector.
Right. Let's talk about another sector or asset class. The hottest place to invest at the beginning of this year was emerging markets, and the returns have been phenomenal. Are you bullish on emerging markets here, short-term, long-term, forever term? What's your view?
Yeah, we have been, for us, emerging markets is a very similar story to tech. We are roughly about double weight in technology. All our client portfolios are roughly about double weight in technology. I shouldn't say all. There's some that are very conservative, they're not. But most of our mainstream portfolios are roughly double weight in tech and have been for quite some time. Or rather in emerging markets, and have been for quite some time. Similar to tech, emerging markets are a sector that are highly, highly cyclical, but people always confuse that cyclicality for growth. It's very difficult for people to understand that because they saw a period of emerging market outperformance that was about 10 or 12 years, from 1998 to about 2008, 2010. And the reason why was that emerging markets were the biggest beneficiaries of the global credit bubble. Now, it wasn't a credit bubble in 1998. It was the beginning of a credit cycle, and you had 10 years of basically uninterrupted expanding credit. And emerging markets were the biggest beneficiaries of that 10-year period of ever-expanding credit availability. So by the time you get to 2008, what does everybody say? They look backwards, they say 10 years of outperformance, and they say, oh, wow, these are growth stocks. And then, of course, they underperform for the next 5 years when they showed their cyclicality. And so my argument is that if you look at the history of emerging markets, you see deep cyclicality. That was masked a little bit by the 10-year credit cycle, which turned out to be a credit bubble. But now we're back to the old emerging markets where they're acting like cyclicals. And I always find it interesting, Matt, that whether it's tech or whether it's emerging markets, that people love the upside and they're willing to play the upside of cyclicality, but then they forget that there's the downside to cyclicality. And instead of admitting that these are very cyclical companies, what they end up doing is talking about some wild growth story, and then they get burned. And I don't understand. I mean, these are just cyclical sectors. Play them as cyclicals, and at least that's what we're doing.
That makes a lot of sense. Let's turn to some things that are in the news right now. What are the impacts of the proposed tax cuts? Is that affecting how you're building portfolios?
It's not affecting the way we're building portfolios, to be honest, because some of the stuff is way too nebulous, right? It's, I think I'm not talking politics here, but I think we all know that, what gets talked about on day one may not be anything related to what happens on day two. So what we've tried to do here is divide it up into two categories and think about it very, very generally. Number one, the personal side. Yeah, they're going to do something. I would not use the word tax reform on any of this, by the way. Our argument has been that Washington would talk about tax reform and it would ultimately just be a tax cut. It would not be real tax reform because tax reform is very, very difficult. If you go back to the 80s, you'll see it took them years to do it and to do it effectively. There's a reason why that was so effective was that they planned it out for years. It was not something that you did on the back of an envelope in like 2 months. It was a very, very long project. Involved academics, it involved Democrats, involved Republicans, it involved everybody you could name was involved in this thing, and that's why it was, I would argue, so successful. This one's a little more nebulous. So on the personal side, they're going to do something. I don't really know what. I don't think people should worry about that right now. Maybe for your own personal finances, that's one thing, but not necessarily for the markets. The corporate side, however, is a slightly different story. And I'm going to choose my words very carefully here. If the effective tax rate in the new tax regime is lower than the effective tax rate in the old corporate tax regime, that is very bullish for the equity market. One has to remember the reason corporate taxes are cut is to benefit the owners of capital. Shareholders are the owners of capital, right? And we could talk about whether that's socially the right thing to do or not, but that's not our day jobs, right? And we're 9 to 5, we're all here to invest. We're not here to pass, social justice or fair or anything else. That's the reality. Cuts in corporate tax rate are designed to help the owners of capital. The owners of capital are shareholders. So if the effective corporate tax rate is lower, I think you have to try to make out a bearish story about that. I mean, I don't understand how it could be bearish for shareholders. Now, the key word I used was effective tax rate. The statutory tax rate will come down, but remember, most companies don't pay that anyhow. So to augment their cash flows, it's the effective tax rate that has to be lower. I think that's going to be the case, but it's funny that we haven't been hearing a lot about that. And I'm always skeptical of politicians on both sides of the aisle. I'm very agnostic in my skepticism, and I think that we want to hear more about the effective tax rate. If it's lower, it's got to be bullish. You can't say it's not going to be bullish. Now, the multiplier effects of all this, that's very sketchy. And that's more politics than reality. And what I mean by that is the stories about creating jobs, about investment, and all that kind of stuff. So let me give you an example about why it's so sketchy. And I think when people hear this, they'll say, oh, yeah, of course, that makes perfect sense. The academic studies do say that if you provide tax incentives for capital investment, companies do spend on capital infrastructure. They do that. We could argue about how much they do and everything, but they do it. However, what is extraordinarily unclear is whether that capital investment is sourced domestically or not. What do I mean by that? Let's say there's incentives for companies to invest in new computers, right? Capital investment. We all buy new computers. The question is, are those computers going to be built here in the United States, or are they going to be built in Taiwan? Well, you know and I know they're going to come from Taiwan. They're not going to come from the domestic 50 states. So the multiplier effect will be muted relative to what the politicians say if that's the case. So I think there's a short-term stimulant here that could extend the profit cycle a little bit by lowering the effective tax rate on corporate profits. But I think we all want to have a raised eyebrow about the promises of the multiplier effects over the next several years, if not decade. Those type of stories, I don't know. But in terms of, hey, if the effective tax rate on corporate profits is lower, let's go, baby. I mean, I think that's fantastic for shareholders.
Party on again. Okay, we have about 4 minutes left. I have a few closing quick questions. Your overall message seems to be party on for now. So when do we know that we have to leave before the cops show up? Like, what will be the signal that the party's over?
Very important question. I would say 3 things. Number 1, corporate profits roll over. Clearly, that's not happening right now. Number 2, the Fed and other central banks remove too much liquidity from the economy. Not that they remove liquidity, but they remove too much liquidity. How do you know when that happens? The yield curve will invert. People are talking about a flattening yield curve. There is a big difference between a flattening yield curve and an inverted yield curve. I'll remind everybody in this webinar that the bull market from 95 to 99 occurred with a yield curve that was flatter than today's yield curve. So be very cautious about these notions that a flat yield curve means the end is near. And then number 3, sentiment/valuation, which we kind of discussed before. I think people are still more cautious. I think 2008 has still scarred investors quite a bit, and they're very hesitant to be absolutely euphoric about equities. My argument still is that will happen at the end. We will see euphoria. We will see the curve invert. We will see profits roll over, and everybody will say it doesn't matter.
All right, we'll party until then. Let's talk about a few more quick lightning round things. Bitcoin. What do you think about Bitcoin?
Crazy.
Crazy.
How's that for an answer? We're done. Let's go.
I feel the same. We don't need to talk more about it. A big question I'm hearing a lot at conferences that I go is this question of ETFs and passive flows distorting the market. Do you see that? Is that a real concern? Or is that active managers whining because they're not good at their jobs?
I think it's the latter. I mean, I don't want to say there's whining, but the same arguments were made 25 years ago about index funds and how index funds were distorting the market because there was so much flow into traditional index funds. Now it's ETFs. Look, if you're buying an index ETF, you are buying the stocks in proportion to their weight in the index. There is no marginal movement that would cause those stocks to change in any way or any form. Now, if you're buying an ETF that has 10 stocks in it and that becomes the most popular ETF, yes, those 10 stocks could move. But the notion that an overall switch among investors to ETFs is somehow distorting the market, I don't think that's true. The questions about does it provide oversight of management and are passive investors passive owners? That's been a story for a long time, and I think that's still a viable story. But I'm not sure active investors have been such active owners either.
Awesome. All right, we have one last question. I'm going to ask it about your American Industrial Renaissance product. Is that story still resonant with you? Are we in an American Industrial Renaissance?
Yes, I think we are. We actually created that ETF with our buddies at First Trust. I think it was about 3 years ago or so, long before people were actually talking about this, because there was a move already underway to reindustrialize parts of the United States, that U.S. industries are becoming more competitive, lots of different reasons. We could do a whole call just on that. I think that's still a very, very viable secular story. I think U.S. industries are gaining market share, will continue to gain market share. I think it's a great story. However, one has to remember that when you're talking about industrial companies, and especially in AIRR, it is small industrial companies, they are inherently wildly cyclical. And so one shouldn't expect that a secular growth story is going to be a stable growth story. That's not what's going to happen. My argument is that air is a great theme, that you stick it away in your corner of your portfolio. You come back in 5 years, you're probably going to be very happy. But if you come back next quarter, who knows, right? It's a crapshoot to some extent, because these are small, very, very cyclical companies. One order can change their entire profit structure. So I think if you're investing in the American Industrial Renaissance, you are really investing almost in sort of a private equity venture type notion where you want to come back in 5 years. I don't think this is the type of thing you trade intraday or that you look at, every morning when you get up. I think you're going to drive yourself insane.
All right. We'll leave it with that. Richard Bernstein, one of the smartest investors I know, will be joining us down at the Inside ETFs conference in Hollywood, Florida, January 21 through 24th, where he is going to be part of a macro debate about where to place your chips in 2018. We'll see if your story has evolved by then, but thanks very much for joining us today. And thanks also to the audience for joining us today. Come back next week for the next Inside ETFs weekly webinar. We're going to be talking about tail risk, volatility, and how to hedge your portfolio for potential downturns in the future. For now, everyone have a great rest of the day. Thanks again, Richard, and talk to you all soon.
Thanks, Matt.